Welcome back to all our tax-savvy real estate investors. And in part 5 of our series on tax entity structuring, we want to talk about some quick tips to reduce your active real estate venture taxable income. Let's make one thing clear. The goal and the first priority of your active real estate business should be to earn you money. Everything else is secondary to that. So once you get the business running and you have a system in place where you're earning this active income, now it's time to start thinking about how you can legally and effectively reduce the tax effect on the income that you're earning here. Oftentimes, the steps we're going to talk about here should be implemented before you even consider converting to an S corporation or even possibly a C corporation. So a few of the topics we're going to talk about here: maximizing and timing deductions, minimizing and shifting income, and viewing your whole picture. So taking a look at what you have from your active income, what you have from your passive investments and your passive losses, and seeing how you can put those together to reduce your overall taxable income. Starting with maximizing deductions. Now that you have an active business and you're a business owner, you have a lot more options available to you that certain W-2 individuals do not have. Most W-2 individuals have no ability to deduct their expenses on their tax return, other than a select few that they might be able to take as itemized deductions. We're just going to touch high level on these for now, and we'll dive deeper into each of these topics in a future video. But these are things such as an auto deduction. So taking your mileage or taking your actual auto deduction and running that through your business. That can create massive tax breaks for you. And you need to do it legally, and you need to document it properly and have a log so that we can ensure we get this deduction maximized. Another common expense that you're able to leverage is travel. If you're traveling, whether it's for business or pleasure, there are ways to make that travel a business deduction. And if you can do so effectively and it makes sense for that trip to do so, you can save significantly by running that travel expense through the business. The other items that come up frequently here are things such as office expenses or IT type equipment. So things that you used to buy as a W-2 employee and bought them with after-tax money, you can now buy, and if they're utilized through your business, you can actually deduct them. But you need to ensure you're actively using them for your business. If you're buying things such as speakers, an iPad, an Apple Watch, those type of items, and you're going to utilize those in your business, you can get a business deduction for them. Now, you need to be sure that you have the proper documentation in place to take these deductions. And we'll talk about that more in a future video. And secondly, you're going to want to be sure that if you are using any of these items for personal use, you track that and you break it up so that we just take the business portion as a business deduction and we ensure we take the personal expense as a non-business deduction. Other items that frequently come up here to think about are things such as dues and subscriptions. So your Amazon Prime memberships, your Costco or your Sam's Club memberships. If you're now using those memberships for business expenses as well, there's likely a possibility to take those expenses and shift them from personal to business use, or at least to take a portion of them. We also have things such as your home office deduction if you're working out of your house that you can take. And that also changes the ability of what you can take as far as your mileage deduction. So all of this kind of works together, but these are ways that you can take expenses that were once personal expenses and shift them over to be business deductions and get the tax breaks on those deductions. So as I said, we'll dive deeper into each of these deductions more in a future video and really how to document them properly and what all you can take that's associated with each expense. But for now, just know that these are deductions that, if done properly, you can use to reduce your active real estate venture business income. The next thing we want to talk about is effectively timing the deductions. If you're a cash basis taxpayer in a cash basis business, the expense is deductible and the year in which you pay it, so long as the product is used or the service is performed and completed within a year. So what this means is if the check is in the mailbox by December 31st of the year, and that product that you purchased is used up within the next year by December 31st of the next year, or that service that you paid for is completed by December 31st of the next year, then that deduction that you put the check in the mailbox for can be taken in that initial year. So it can lower your taxable income in that initial year. This can come up frequently for things such as paying January's rent on December 31st. And while this isn't always an effective tax strategy year over year, for an early business owner or for a business owner in the first year of having success, this can be an effective tool to understand and use appropriately. Now, getting deeper into timing the deductions is using leverage to purchase fixed assets. And when this makes sense, it can be a thing of beauty. But it's not to say go purchase a car just to purchase a car. If your business needs equipment or needs fixed assets and needs these large purchases, those can be great tools to reduce your taxable income. And the thing that every taxpayer needs to understand is that it does not matter how you purchase the item, whether you use leverage to do so or not. And what I mean by leverage is a loan or financing. So let's say you go buy that $60,000 piece of equipment and you only put 5% down or 10% down or a deposit down, and the rest is taken on a loan. That item can still be fully set up as a fixed asset in the current year. And that fixed asset can have depreciation expense taken on it. And with the rules around bonus depreciation, which we'll get into a little deeper here in another video, you can end up having a massive deduction from that item that helps to offset your taxable income in the current year. Now let's move into minimizing and shifting your income. Well, with shifting your income, the first way you could do that is through generations. So what am I talking about here is, hiring your kids, the popular strategy that you've probably seen all over social media. But what we're gonna talk about is how to legally and effectively do it. And we'll probably even go into a full video on this later on. But what you need to know for now is there are many benefits to effectively hiring your kids. However, you need to do so legally. You need to put in place an employment contract with the kid, just as you would with any other employee. You need to pay them a fair and a reasonable wage. They need to actually perform the work. So this all needs to be documented very well and laid out very well. The kid also needs to be of an age where they can actually perform the work that you're having them perform. So again, this can be a great tool to use, but let's get these first steps right. So what are the benefits to hiring your kids? Well, there's actually 3. The first is that you can pay the kid the wages, the salary that they earn, and whatever you pay them, the business is going to get a deduction for that, which means that's going to come off of your taxes. So if you're in a 25% tax rate, you just got a break on the $10,000 that you paid the kid. The next benefit is that this income goes to the child at their tax rate. Well, the 2025 standard deduction is $15,000. Meaning if the child earns up to $15,000, they're not going to pay any federal or state income tax on it. Now going further, if these wages are paid through a non-S Corp or a non-C Corp, they're also not subject to Social Security or Medicare taxes. Meaning your child will get these wages and have 0 tax withholdings. And the last benefit to hiring the kids is to take the money you pay them and put it into a Roth IRA. If you're paying them money and you don't need to use that money for expenses that the child is already paying or has themselves, they should take that money and consider investing it in a Roth IRA. For the tax year of 2024, the child could contribute up to $7,000 of earnings into a Roth IRA. Because that money was never taxed initially, they haven't paid any tax on it. Once they put it into the Roth IRA, it will grow tax-free. And so long as they don't take it out until they're of retirement age, or they only take that money out for a qualified event, they won't pay tax on the distributions. So you've effectively hired your kids, paid them a fair wage, got the money off of your taxes, and the child has not paid any taxes on it, nor will they ever. If you pay them more than the amount that they can contribute to that Roth IRA, well, now they could take that money and they could start paying for expenses that they already have that you're probably funding as their parent. Things such as private school, travel sports, hobbies, any extracurriculars, those can start to come out of the kid's bank account. So what you've effectively done now is not only shifted income, but also shifted expenses. You've taken expenses that were yours and you did not have a tax deduction on, to making them the child's expense and paid through a salary which you did get a tax deduction on. The next item to talk about here is shifting income between years. And similar to thinking about maximizing your deductions and shifting your deductions between years by paying things out on December 31st, or maybe waiting until next year if it makes sense and you're gonna be in a higher tax year next year, it's the same for income. The income is earned and has to be reported in the year in which you take constructive receipt of the money. So what that means is if the check is in your mailbox on December 31st, you need to claim that income. Well, if you're a cash basis taxpayer and those are the rules in effect, how can you manipulate this a little bit? And when does it make sense to do so? Well, if you're a cash basis taxpayer, and these are the rules that you have to work within, and you time your invoicing or your services so that a lot of them are done towards the end of the year but not paid until January of the next year, that's income that you're not going to have to pay until the next year. So this does a couple things. One, if you're gonna be in a higher taxable income year this year, that could make sense. But also, we're talking here about the present value of cash, meaning cash that you have in your pocket today is worth more than cash in a year from now. So if the income doesn't have to be claimed until next year and you don't have to pay tax on that income until the following year, that's more money that you can keep today. And you can realize the benefits of that today by paying less in taxes. And now the last piece that I want you to keep in mind here is to view your tax circumstances by looking at the full picture. Take the spouse's W-2, take your active real estate income, take the losses potentially from your real estate investments, and know what is going to be matched together and what your ultimate tax situation is going to be. Because you may not need to make that S-Corp conversion. If you meet reps and you're going to have losses from your real estate investments this year, or there's ways to create and accelerate those losses, which we'll talk about in the next video. So put it all together before you make any decision. Don't make any tax planning decision in a silo. Ensure you understand the whole picture, or you're working with a qualified accountant who can help you understand the full picture so that you're paying the least amount of tax possible and you're optimizing your tax expense year over year. In our next video, we're gonna dive deeper into how you can create, increase, and accelerate those passive real estate losses so that we have something over here that we can start to use potentially to not only offset our passive income, but also possibly offset our active real estate venture taxable income that we've created.